Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning, and this is Peter Lewis, and a warm welcome to my podcast Money Talk for Wednesday the 19th of July. And thank you for making Money Talk one of the most listened to financial podcasts in Hong Kong and also now in Singapore. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, China's top economic state planner, the National Development and Reform Commission, vowed Tuesday to restore and expand consumption in a plan to bolster growth that includes boosting household income, improving the business environment for private firms and stabilising youth employment. Shortly afterwards, the Commerce Ministry followed up with the announcement of an 11-point plan to boost the domestic consumption of household consumer goods and services. Local authorities are encouraged to help residents refurbish their homes, and people should get better access to credit to buy household products, according to the plan, which was released jointly by 13 government departments. US Climate Envoy John Kerry said the global warming crisis can't be solved without both nations working together as he continued his 3-day visit to China. Chinese Climate Envoy Xi Zhenhua cast the talks as a chance to pursue substantial outcomes. However, in a meeting on Tuesday, China's top diplomat Wang Yi told Mr. Kerry that China-US cooperation on climate change can't be separated from the overall environment of China-US relations. Indian billionaire Gautam Adani predicts that India will be the world's second largest economy by 2050, with income accelerating by over 700% to about $16,000 a head. Speaking at the annual shareholders meeting of his conglomerate Adani Enterprises, he said, "I anticipate that within the next decade, India will start adding $1 trillion to its GDP every 18 months. Hong Kong's seasonally adjusted unemployment rate fell to 2.9% in the 3 months ending June from 3% in the previous March to May reading. That's the lowest since September 2019. The underemployment rate also dropped slightly to 1.1%. On today's programme, I'm joined by Nitin Dialdas, Chief Investment Officer at Mandarin Capital, and Sunil Kashyap, Director of Finmet. With a view from Japan is Tokyo-based journalist and author William Pesek. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
On Wall Street, US stocks surged Tuesday, boosted by a robust set of earnings from the big banks. The S&P 500 added 0.7% to close at 4,555. The Dow rose 367 points, or 1.1%, ending the session at 34,952. That's a new 52-week closing high. It was the 7th straight positive day for the Dow, the longest winning streak since 2021. The Nasdaq Composite settled 0.8% higher at 14,354. All three major averages had their highest closes since April 2022. Texas-based broker Charles Schwab surged 12.6% after it reported quarterly results that beat Wall Street estimates and said the pace of deposit outflows has continued to slow. Bank of America, the second largest US bank, gained 4.4% after reporting a 19% earnings rise. Morgan Stanley added 6.5% after executives said client activity strengthened during the quarter. Shares of Microsoft rose 4% to a fresh all-time closing high after the company announced plans to charge businesses $30 a month per person for access to an AI-powered assistant for Microsoft 365, its popular workplace software that includes Word and Excel. It also announced that it will make Meta's AI model, dubbed Llama 2, available to developers building software on Microsoft's Azure cloud computing platform. Hong Kong stocks tumbled Tuesday after markets resumed trading following a day-long halt triggered by Typhoon Talim. The Hang Seng Index ended the day 398 points, or 2.1% lower, at 19,016. The tech index dropped 2.4%. Real estate and technology stocks led losses on the Hang Seng Index. Real estate developer Long4 Group was the biggest loser, its shares sliding almost 10%. While Country Garden saw an 8% fall. Tencent dropped 4.6% and Alibaba fell 3.5%. On the mainland, the Shanghai Composite was 0.4% lower at 3,198, and home improvement stocks were among the biggest gainers following the release of China's 11 points consumption plan. The pain for Hong Kong stocks looks set to continue this morning, with the Hang Seng Index forecast to open another 60 points lower. That's 1/3%. And you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Time to welcome our guests. On this Wednesday morning, we have with us Nitin Dialdas, Chief Investment Officer at Mandarin Capital. Morning, Nitin.
Good morning, Peter.
And also with us Sunil Kashyap, who is Director of Finmet. Good morning to you, Sunil.
Good morning, Peter.
Let's start going through this 11-point blueprint that the state planner has come out with to boost demand. The National Development and Reform Commission vowed Tuesday to restore and expand consumption in a plan to bolster growth. That includes boosting household income, improving the business environment for private firms, and stabilising youth employment. Jin Jiangdong, who is an official with the NDRC, said Tuesday consumer purchasing power and expectations are relatively weak, while consumption infrastructure and environment need to be improved. He said we will promptly formulate and introduce policies to restore and expand consumption and issue policies to stabilise large-scale consumption, promote the consumption of automobile and electronic products, expand rural consumption and optimise the consumption environments. The state plan also vowed to address youth unemployment in China, which came in at a record 21.3% in June. The NDRC said it's going to increase service and policy guarantees, step up support for job stabilisation and expansion, although it didn't provide any further details. And then shortly after that, the Commerce Ministry followed up with the announcement of an 11-point plan to boost the domestic consumption of household consumer goods and services. And local authorities are encouraged to help residents refurbish their homes, and people should get better access to credit to buy household products. And the Ministry of Commerce said at its website the 11-point package is aiming at unleashing the potential of household consumption. So there we are, Nitin and Sunil. There we have it. We've been waiting for a fiscal stimulus plan of some sorts. This seems to be a key part of it. What's your initial reaction to this?
I think it's a little bit paradoxical because on the one hand you've got the Chinese guys looking at common prosperity, so you look at the finance industry, they're lowering wages, they're making sure people don't earn so much, but at the same time they want consumption to be increased. It doesn't go hand in hand. And it's not like it's a zero-sum game where if I take away $10,000 of earning from one person, someone else is going to get that $10,000. It doesn't work that way. So I don't think they've actually quite got this right yet, because the reality is people will spend when they feel that they've got surplus income. And if you're taking away income from people, they've not got that surplus, and therefore that consumption side, I think, remains weak for a long time.
Maybe I've got a little bit of more positive spin. I think you've got to look at the context. You know, a year ago, for example, even 9 months ago, the Chinese government was more focused on COVID and other non-economic issues. I think what we're seeing now is an increasing realization amongst the party and the leaders that the economy really matters. There are problems and it needs to be addressed. And so besides just, telling the SOEs to do more, I think they realize that they need to increase personal consumption and even help the private sector. So this is just one additional step along the way. Is it enough? Of course not. But I think it's a signal that they are going to do more and more, or anything, I wouldn't say anything, but as much as they can to try and turn this economy around.
What is it in the plan that makes people more likely to go out and redecorate their home or buy some new home appliances? Because I don't see anything in the proposals that either specifically encourages you to do that or puts more money in your pocket to enable you to go out and spend.
Sunil's a positive one.
So I think it's about credit, right? So they're saying there should be more credit growth, especially for personal credit. So it's just a signal. I mean, you're going to see more steps in the coming weeks, and it's all to do with trying to improve the sentiment. The sentiment up to now has been very pessimistic in the last couple of months. The topic of youth unemployment has been front and center in a lot of the media, and I think the government is trying to now turn the narrative around. is this by itself going to be enough? Of course not.
I mean, that's the issue, isn't it? Because it's not a lack of credit. There's been record amounts of credit pumped into the economy. It's more a confidence issue. Consumers are worried about the value of their homes going down, about their job security, about getting sick. So spending isn't their priority. How does this improve that confidence?
Well, I think there's a credit problem in China as well, so I'm not necessarily think that's actually a good thing to increase credit even further. So, I mean, as I said, the measures, I agree with Sunil in the sense you're trying to send a message to the market that you're trying to help, but the best way to actually help is to alleviate some of the measures that you've taken over the last few years, which is allow people to earn money again, allow people to feel confident, allow people to have surplus income, because that filters through the economy. I mean, just turning around and going, bankers earn too much, let's lower their wages, or people can't, do ride-hailing services anymore, or you can't charge for tutoring. All of these things, which are income for people, which is now being taken away, that's what's stopping your consumption, or that's what's hurting you. Allow people to earn money again, allow people to charge for tutoring, allow, all of that to happen and see what happens, because it's all a filtering effect. It's not, as I said, it's not a zero-sum game where if I stop people paying for tutoring, some other guy's going to earn that money. It doesn't happen that way. It's just that is a necessity for my kid to be tutored. No one's going to do it if they're not going to earn any money. So now I can't have my child, better his education. There's also the fact in terms of, like I said, of bankers. They'll go out, they'll spend at top restaurants. Restaurants will employ people, probably from the lower end of the sector. Those guys start earning money. It's a whole ripple effect, and I don't think they've quite got that right in terms of understanding how you have this ripple effect when it comes to consumption. And adding a bit of credit where you're already pretty much over-debted, I don't necessarily think is a great thing. Sorry.
Yeah, I mean, for sure, I think there's a couple of things, again, in context. There were a lot of infrastructure and a lot of issues regarding corruption, regarding the way that the economy had grown over the last 20 years, which the government clearly felt that they needed to address. Now, addressing it in a drastic way without leaving an alternative or without having a transition, I think is a problem. And I think that's something the government is learning also. And that's where I think they need to do some more work, is that they can't be drastic about statements. And unfortunately, the governance system we have in China creates that situation where it's black and white, and you don't leave room for transitions. I think that's where the real change needs to come about.
I mean, there's a lot of ideology involved, isn't there? That's why you've seen it's not just an economic issue. It's why you've seen, for example, online education, tutoring closed down, which was another reason why we've got record youth unemployment now, because that would employ a lot of those graduates. So it seems that the ideology is getting in the way of the economics here.
Yeah, very much so. And if you think about the youth and you look at the gig economy, whether it's, like you said, tutoring, whether it's, even being a DD driver, just to earn a little bit of income on the side, all of those have been taken away. So yeah, it's no surprise to see high youth unemployment. They're not necessarily, and again, like I said, going into traditional sectors, it's not as attractive as it was because they're being clamped down as well. So I think from, a youth perspective, it's a tough ask at the moment. When you've got 21.3% unemployment at the youth level, that's huge, and that in itself becomes a massive social problem that they do need to address and need to address very quickly.
These wounds are really self-inflicted, aren't they? I mean, government policy is largely to blame for this slowdown, because for decades China's relied on this investment-driven growth model. And now, when it needs a consumer-based sort of economy, it's sort of lagging behind, isn't it? So it's not going to be easy for it to turn this around.
It's not easy, but there are certain imbalances that were created over the years, and there's a view that the market is self-correcting and things will correct themselves, and it wasn't happening. The imbalances were increasing, so the government really needed to do something. And I think what we're seeing now is a little bit of fine-tuning. We've seen with the tech sector, for example, they've rolled back some of the measures that they had done to restrict the growth of the tech sector. So they are making sort of self-correction steps now, and it's just a matter of time where I think you will see more of these changes come about, especially some of the private enterprise issues and some of the small SME sector needs more changes, I think.
It seems to me there's two big issues that the government's got to deal with. I'm wondering if you think they are being focused on. The first one is the economy is on the verge of slipping into deflation, isn't it? Consumer price inflation is zero. Producer price inflation is sliding rapidly. It's already negative. And if the government doesn't do something about this, what's the risk that it just gets into a self-reinforcing spiral where people don't want to spend because they think things are going to be cheaper anyway in a few months' time, which worsens the deflation and worsens the slowdown? Do you see anything in what the government has said that addresses that issue?
You know, the sad thing is you'd look at Japan in the 80s, the wonder story that it was from the 70s and 80s, and then you had the massive years or the long years of deflation. You've also got a demographic issue, which Japan's also having to face. There's a lot of similarities there, and if they haven't learnt from what happened in Japan, I think, as I said, it can be quite tricky. The good thing is, obviously, they do set policies and they can flip. So I think if things start really getting totally... I think we're not too far off where it's getting really drastic, but if it gets to a point where there is proper social unrest, I think they're going to have no choice but to try and address these in a more drastic way and start allowing, as I said, a lot more of the private sector to come back into play, freedom of choice of wages and all that kind of stuff. And but at the moment, I understand the ideology, I understand what they're trying to get to, but to me, there's two solutions. You either then decide we're just going to have universal wages, and the state decides everyone's got the same wage, which is very, very difficult to implement, but you've got to just figure out how you're going to do that. Or you just go back to allowing this to be somewhat of a free economy is, I guess, the best way of putting it, but allow private sector to flourish again. I can't really see a way out of it outside of those two.
No, you're right, and there's a big issue also happening, which is the world is slowing down. Right,
yeah.
Everybody, the central banks around the world are trying to raise interest rates and slow the economies down. So you have a context here where China is trying to expand at a time when everybody else is trying to control interest rates, control growth. So it's going to be difficult.
Does that mean it's going to export its deflation around the world?
There was a statement made a couple of days ago, I think, by Yellen, saying that the impact of the slowdown in China is going to be felt across the world, and the deflation, I think, is something that the Fed will keep in mind. The deflation coming in from China is going to be a factor that the Fed is going to keep in mind over the next few months.
And the other problem, of course, is the property markets. That it started to decline once again. It looked like it was stabilising at the beginning of the year, but now prices and sales are sliding once again. The problem there, isn't it, is that the funding model for property developers is broken now completely. And they haven't come up with a new way of dealing with this. How are property developers going to fund themselves? Not many of them are in a position to do that. What's the impact here? What's the solution going to be here?
I think it's also driven by confidence. So what's happening is they created some backstops. They asked the state-owned banks to support the real estate sector, provide loans, etc. But the problem is the confidence of the buyers is affected, and so you don't have the uptake in terms of people buying properties, buying apartments, and that's affecting revenues and cash flows for the companies.
And what are they going to do about youth unemployment, 21.3%? They said it's a priority, but I didn't see any specific concrete plans about how that was going to be brought down.
I think your guess is as good as ours. Like you said, they noted it, but until you see some concrete policies, I can get. It's going to be a wild guess in terms of what they're actually going to do. For me, like I said, the youth are focused on tech, gig economy. There is also a bit of an older. I wouldn't say they're all going down that. They're all going to go down that route, but there's obviously a high level of that. Then there is the old economy, but for me, it's about, are the jobs there? So you have to create the jobs. No one's going to hire anyone unless they've got jobs vacancies. So first of all, you've got to create the jobs in order for these for the youth to go into. Secondly, you've got to give them something that they're actually passionate about, that they want to go into, because And this is a global phenomenon, not just in China, where a lot of the youth today are deciding what they want to do. And if they don't get what they want to, if they're not getting what they want, they're not going to work. And they're quite happy to sit out now and wait till they get something that they want. It's not like the old days where you get the job because you've got to pay bills. Today, it seems very much that you've got a youth that is very much in control of what they want to do. They want that work-life balance. They want to do a job that they enjoy. So you have to create all of that and create an environment for it. And, let's see where the policies go. But at the moment, like I said, your guess is as good as ours in terms of...
And I think that's what Nitin is saying. Basically, there has to be a private sector, public-private kind of solution to this. It can't be done all just by the public sector.
It needs private companies to really sort of boost investment, doesn't it? Because they're not spending at the moment. They're not investing.
Right, exactly.
So is China going to reach its 5% growth target this year?
Well, it depends on stimulus, right? Remember, the Chinese government still has a lot of control over the SOEs, and so it can pump money into the SOEs and do infrastructure growth. I think they're trying to resist that right now, but we'll see what happens after the third quarter, whether they actually try to boost the numbers by spending more.
They'll figure out a way to hit the 5%, won't they? Because they've said they're going to do it. They will publish that figure. Now, how they do it, let's see how they get there.
It seems a lot of the investment banks are now revising down their targets for this year, and 5% now, which was sort of previously a floor for growth, has become their ceiling now.
Yeah.
How much is the geopolitics also an impact here? We had Janet Yellen say over the weekend, she's in India for the G20 Finance Ministers Summit, that it's going to be premature to relax trade restrictions. The US is doing this 4-year review of the trade tariffs that were imposed on Chinese exports by President Trump, but it looks like they're going to stay. She was saying it's really too early to lift them, and that wasn't going to be part of the thawing, if you like, of US-China relations. How much is all of this geopolitics and talk about now investment controls as well from the US on certain sectors in China impacting the economy?
I think it's having some effect, but then there's also a cost effect. And I think what you've seen, and it's pre-COVID, you were seeing this already. COVID obviously slowed it down for a bit, and now in the last year, you're seeing it again, is that there's been a shift away from, certainly on the lower end of the manufacturing, away from China. So that had already happened, and that was just a cost effect, where the garments were going to Vietnam, Bangladesh. And last year we've seen some chips going into India, even the US. So there was a bit of a supply chain thing where we want some stuff closer to home. There was a bit of cost effect in terms of Vietnam, Bangladesh, India offering better cost value. All of that had happened, say, over the last, 7-8 years. So yes, the tariffs have played some part in it, but wages is a big part of that as well. And Indian wages are probably half of what they are in China. Vietnam's probably slightly higher. Bangladesh is similar as well. So you've got all of these effects coming into play. So I don't necessarily think, with or without the tariff, I think that was always going to happen. And China was kind of somewhat being prepared for it, because they wanted to move into the high end of this manufacturing side on the chips and all that. I think what's had more of an effect is the tech war. So, the fact that you've got American chip companies can't buy from China and all this kind of stuff, and having to do all this paperwork, investors, of US investors can't even invest into Chinese chips, all that. So I think, to me, that's had more of an effect in terms of the China game plan than necessarily just saying, okay, there's tariffs on, say, clothes and all that kind of stuff, because that was already moving away from China before.
Mm-hmm.
Yeah, and I don't think it's changing. I don't think, that the what Yellen is talking about really is saying that there's not going to be too much of a thawing of relations, because remember, US is getting into an election cycle now, and China is a favorite beating stock in terms of the politicians. So both sides of the aisle are have an anti-China stance, and that's what sells for elections. So I don't think there's going to be any meaningful change in the US stance towards China.
I mean, we've got quite a lot of US engagement at the moment out here in the region. John Kerry's in Beijing for the climate change talks. Janet Yellen is in India, but it doesn't look like either meetings have really moved very far forward. We had at the climate change meeting, Wang Yi saying that cooperation on climate change can't be separated from the overall environment of US-China relations, which doesn't sound very optimistic. And then at the G20 finance ministers' meetings, they seem completely deadlocked on trying to come up with some sort of statement on debt relief and on the Ukraine war. So for all the talk about engagement and putting a floor under relations, they're not actually moving very far, are they, in terms of positive outcomes?
Yeah, I think they focus more on not making it worse, but not necessarily making it better.
Everyone's got their own interests at play, right? So it becomes a very difficult discussion. Don't forget, India's doing a lot with Russia, so they're not necessarily going to go all out and let's criticise Ukraine. Let's go and support Ukraine, obviously, because they do. A lot of their business is being done with Russia. So it's everyone's got their own agenda in this, and it becomes very difficult to play to or discussions to have.
Let me switch countries and get your thoughts on the US economy, because we've had some data overnight there. First of all, retail sales rose 0.2% in June, following an upwardly revised 0.5% increase in May. That did miss economists' expectations of a 0.5% rise. But core retail sales, which excludes automobiles, gasoline, building materials and food services, that surged 0.6%, more than double expectations. And then we also had industrial production, which was much weaker than anticipated in June. That fell 0.5%, accelerating to the downside from the decline of 0.2% seen in May. And manufacturing, it was the manufacturing output led the decline, falling 0.33% compared to growth of 0.1% in the prior month. What is the state of the US economy? People are talking about, well, it's sort of in a Goldilocks phase at the moment now, where the Fed is, in effect, they think, succeeded in getting inflation down, but without tipping the US economy into recession. But what's your assessment of that?
I think we haven't seen the full effects of the interest rate rises yet. So I think now these numbers that you're starting to see are probably going to be the first realistic numbers in terms of what the effect of the interest rate rises are going to have. At the moment, talking about Goldilocks, because earnings have been pretty good. I think it's about 82% of the companies so far have beat expectations. So everyone's focused on that and going, oh, things are looking wonderful. But let's not forget, earnings is a back quarter. It's not the current quarter. And yes, they've got the outlook, and the outlooks have been okay. But I think now is when you're starting to see the effects of those interest rate rises. So Goldilocks for now, but I would be quite cautious saying let's going into the third, fourth quarter of the year.
And that's right. I think most of the data that you're seeing, which is sort of not reaching expectations, are leading indicators like PPI, industrial production, etc. So this is the beginning of sort of the turn that people had been predicted for some time. Mm-hmm. So I think you have to look at it dispassionately and see. You can see the turn happening. You don't know the speed at which this is going to get reflected at the retail level, but it's coming, and the impact is being felt. So in terms of Fed increases, for example, you may get the one next week, but I think that's probably going to be the last one, because you're going to start seeing data that shows that the economy is slowing down.
Are they going to be cut?
Eventually, right? I think the pace at which the economy slows down, wage growth slows down, unemployment goes up, all of that is going to dictate what the next step is going to be. But the first thing to look for is that that point where they say we're not going to raise it, we're just going to wait and watch.
Okay. Well, thank you both very much for coming in this morning. Good to talk to you. That's Sunil Kashyap, who is Director of Finmet, Nitin Dialdas, who is Chief Investment Officer at Mandarin Capital. I'm joined now by Tokyo-based journalist and author William Pesek. Good morning, William.
Morning, sir.
Let me ask you about the Fukushima wastewater issue. Hong Kong's planning to ban imports of seafood and other aquatic products from 10 Japanese regions if the nation discharges treated wastewater from the Fukushima nuclear power plant into the ocean. This is causing quite a lot of tension, isn't it, between Japan and China, Japan and Hong Kong. Why is Japan doing this, first of all?
Well, I think, certainly the Fukushima crisis, it's amazing that we're still talking about this, a dozen years later, but here we are. But I do think that we're talking about this now because Japan, the authorities here, and also TEPCO, which runs the nuclear power plants up in Fukushima, have been dragging their feet. They've been very, very slow to act and to take steps to stabilize the region. There's still large parts of Fukushima that are uninhabitable. And so Japan is finally taking steps to rectify the situation. The problem is that this controversial step they're taking, arguably in the days or weeks ahead, is creating geopolitical tremors around the region. I think that it's a reminder that Japan has a lot more heavy lifting to do in terms of diplomacy in the region. It has a lot more discussion to do with Hong Kong, with China, with South Korea, and Taiwan to explain exactly what it's doing and why Japan believes that these steps are needed and also reasonably safe, all things considered.
The International Atomic Energy Authority says that the wastewater is safe. It's not going to cause any damage to fish. The fish won't be contaminated, but the countries around Japan don't seem to be happy with that.
No, of course. I mean, anytime you have a nuclear leak, and certainly Japan is still dealing with this a dozen years later, it's an international event, right? And again, I do think that Japan needs to do a better job of making its case to neighbors. Japan's diplomatic corps is not really great about sitting down with neighbors and explaining what it's up to and what it's doing. And this is one of those moments where Japan's soft power can take a significant hit in the region if Japan doesn't handle this better. I mean, I think that the science of this is that generally that these risks are reasonably contained, all things considered, but the geopolitical risks are the ones that Japan needs to be working on a lot harder than it is.
And China's the top buyer of Japanese seafood. It says it's going to extend a ban on food imports from Fukushima. Hong Kong is going to ban seafood products as well. What sort of impact would that have?
Well, certainly the timing is terrible for the Japanese economy, right? We have the Japanese yen for the most part. It's been up in recent days, but generally it's plunged this year. And so Japan has been hoping for a big boost in exports, and any kind of ban you see on Japanese products, on not only on fish but also produce, will be a hit to the economy. Not a major hit, but at the margin, it's very badly timed for the Japanese economy and for the Japanese government.
And you mentioned the yen. As you say, the yen has been very weak this year. Apart from, it's sort of rebounded the last week or so, and that mainly seems to be on anticipation that the Bank of Japan is going to end its yield curve control policy fairly soon. There is a Bank of Japan meeting next week on Thursday and Friday. But yesterday I noticed that Governor Ueda really tried to knock that on the head, saying there's still some distance to achieve this 2% inflation target, and until that's reached, the monetary policy isn't going to change. So we're sort of left a bit confused, aren't we? What do you think about the yield curve control policy? Is it going to go as the markets expect, or are they going to be disappointed?
Well, I could be making a fool out of myself at the moment by saying this, but I think Ueda is right about this. I think that the idea that Japan will be acting next week is a bit of a reach. It is possible you'll see some kind of tweak, if you will, just the BOJ reminding markets that it's still here, kind of signs of life, if you will, but the BOJ is still around. And I think that you might see some kind of effort to close the gap between Japanese 10-year bonds and U.S. 10-year bonds. But I do not expect any kind of major step in that direction. And I think the reason is because Ueda is pretty new at this job, and I think he's still trying to figure out what's what. And I think there's a great concern that if Japan takes a significant step with its monetary policy, the stock market will tank. It will become a global event. And one of the things that the BOJ is looking at is the fact that the Nikkei has been on this bull run this year, and Japan's been in the headlines for some of the right reasons. And the last thing the Bank of Japan ever wants to do, no matter who's running it, is to be blamed for a recession. And so if you're Governor Ueda, I think the odds probably favor the BOJ not stepping away from quantitative easing anytime soon, or yield curve control anytime soon. But again, I could feel very stupid a week from now.
It's always hard, isn't it, to guess what central banks are going to do. But also,
it is.
You have to take into account, I presume, that inflation in Japan is double the Bank of Japan's target. It's been above its target, for 14 months in a row now. So inflation is going up, isn't it, in Japan? Maybe the Bank of Japan sees this as being temporary, but the figures say that there is a much higher inflation now.
I mean, inflation is becoming a genuine problem. I was out with a bunch of friends last night, and that's all anybody was talking about, the price of things like, eggplants and meat and chicken and coffee. Prices are going higher. People are feeling it. Hotel stays, for example, for people who want to travel around the country are rising. I think the other problem, too, is that the labor unions in Japan recently secured the biggest wage increase in about 30 years. And that's a great thing for the Japanese worker. We haven't had big raises in decades here, but the timing of this is problematic in that it's another reason to think that inflation might become ingrained. And so if you are the BOJ, you have this incredible balancing act. On the one hand, you've had quantitative easing for 23, 24 years, and so you're reluctant to step away from that because it might crash the stock market and send bond yields higher. But the longer that the BOJ remains on autopilot the way it is at the moment, the more inflation could become ingrained. And a lot of inflation, of course, is psychology. It's expectations that get built into the system. And if the BOJ doesn't at least tap the brakes a little bit in the weeks and months ahead, these inflationary increases could become permanent. And that's a concern.
And if the Bank of Japan doesn't do anything next week, presumably then the yen's going to resume its decline, and then the stock market can resume its upward trend, because that's also stalled out a little bit, hasn't it, with the reversal in the yen?
That is true. I mean, you've seen this cause and effect with the Nikkei looking at the yen and taking its cues from that. I think the other interesting thing is, I do think the odds favor the yen continuing to weaken. Of course, I'm heading to the U.S. next month, so anytime I go to the U.S., the yen is plunging. Basically, I've got very bad yen karma. But I think that the interesting factor is how China views this, right? I mean, China's economy is underperforming. Nothing would help China's economy more in 2023 than the Chinese currency becoming more stimulative, more accommodative in terms of exports. And so, if the yen falls in the weeks and months ahead towards, say, 150 or even 160, does that give China political cover to follow suit? And then you get into all kinds of problems in Washington because there's a presidential election coming up, and the Republicans and even Joe Biden wouldn't like to see the Chinese currency weakening. So it's an interesting time given currencies in Asia.
It is interesting, isn't it, how Japan's performance is linked to China's, in the sense that it's actually the mirror image of what China's doing, because hedge funds in particular have been shifting money out of China and then moving that into sort of Japan, because there are these concerns obviously about Chinese growth and also the geopolitics.
Right. I mean, like Larry Fink at BlackRock has been talking about how investors, they don't want to pull their money out of Asia because of the growth story here. But a lot of investors seem to be moving money out of China into Japan, of all places, because it's considered a safer place, a bit of a haven at the moment, and it's considered a better undervalued market to ride Asia's economic boom relative to China's. And so in some ways, Japan is benefiting from the concerns you see about China's economy. And of course, the regulatory environment in Beijing is still uncertain. We still keep on hearing lots of talk about how the tech crackdown is over. We're moving forward. But then there are hints that come out 2 or 3 days later, which give you the impression that things are still a bit uncertain. So Japan is benefiting from that. Warren Buffett is arriving even. So an interesting time for Japan. We're suddenly in the headlines for some of the right reasons. And I think the government likes that. The BOJ doesn't want to be the one to, basically change the narrative to Japan heading into recession, Japan's stocks falling. And so that's why I think you have the BOJ remaining on autopilot. Again, I could feel very dumb in a week.
What is interesting is fund managers now starting to call for Asian products ex-China. Just like back in the 1990s, we started to get Asia ex-Japan, and we had indices, the MSCI index of Asia ex-Japan. They're now calling for Asia ex-China, which is a sort of an interesting turn of events, really, isn't it?
Exactly. I mean, it's good news for Korean stocks. It's good news for Southeast Asia. But yeah, things are going full circle in that way in certain ways. And, you just have to hope that Xi Jinping in Beijing is reading these headlines and realizing the extent to which this capital, once it leaves China, might not come back for a while. So it's best for China to be taking steps right now, not just to stimulate the economy, but to reform the financial system and remind people that 10 years in, that the Xi Jinping era is able to put some big reforms on the scoreboard. We haven't seen as many as investors had expected. Okay,
William, it's always great to talk to you. Thank you very much for that. That's William Pesek, Tokyo-based journalist and author. Peter Lewis's Money Talk. Thank you very much for listening this morning. Don't forget to take a look at my daily newsletter, which is at peterlewismoneytalk.substack.com. I'll have more business and finance updates for you tomorrow. Joining me to discuss them are Andrew Ferris, the CEO of Econosis Advisory, and Alex Frew-McMillan, who is a freelance writer and Asia columnist for TheStreet.com. And we're also going to talk about Asia's frontier markets once again with Ruchir Desai of Asia Frontier Capital. Please join me again tomorrow.
Money Talk